If you could ask any investor to teach you their strategies, who would it be? Many people would say Warren Buffett, and for good reason. The legendary man behind Berkshire Hathaway is one of the most successful investors ever. And while I don't have Warren on my speed dial to teach you his investing strategy himself, I can offer the next best thing. A breakdown of the book that inspired much of Buffett's investments, which he called the best book on investing ever written. In this video, I'm highlighting the most essential lessons from The Intelligent Investor by Benjamin Graham. Meet Ted. Hi, Ted. Ted is a new investor who is eager to learn how the very best investors make their decisions. Ted decides to read The Intelligent Investor and apply everything he learned to his investment strategy. We're going to follow along and see how things turn out for Ted. The first key takeaway Ted learned from Graham's book was the importance of understanding the difference between aggressive and defensive investing. This decision is personal and depends on how comfortable you are taking risks. Aggressive investors don't mind taking on more risk to pursue higher returns. Defensive investors, on the other hand, prefer to take fewer risks and minimize losses. Ted is tempted to go in with guns blazing and make aggressive moves, but then he remembers the most important thing Benjamin Graham said about risk. Risk and reward are not always correlated. You don't have to take a higher risk to achieve a higher reward. Intelligence and skill are more important and are more predictive of the success of an investment. The best investors use all the other tools Ted has learned to make informed decisions and reap significant rewards, regardless of their risk tolerance. Ted is interested in investing in a small tech company that caught his eye, but can't decide when to jump in. Some days it seems like tech stocks are destined for the stratosphere. Others feel as laggy as an outdated Mac. Thankfully, Ted knows the next key takeaway from The Intelligent Investor: understanding Mr. Market. Ted thinks of Mr. Market as a moody investor with days of over-the-top optimism and despairing pessimism. A more modern-day analogy would be to think of Mr. Market as a crypto bro who buys and sells Dogecoin based on Elon Musk's tweets. He makes investment decisions based on his erratic mood, buying and selling with every price fluctuation. Mr. Market is more than a single investor. He represents the market as a whole. The stock market is influenced by investors like Mr. Market, and so it becomes Mr. Market itself. Ups and downs in the market are driven by the reactions, emotions, and moods of investors, and don't necessarily reflect the actual value of your investments. A good investor knows that you should invest for the long term based on careful analysis and strategic risk planning. Ted embraces Mr. Market like an old friend, using his mood swings to find pockets of new opportunities while refusing to fall victim to his drama. Okay, maybe not quite like an old friend. I'm sure most of us aren't looking to exploit our friends' emotions for our own personal gain, but you know what I mean. Once Mr. Market is dealt with, Ted is free from making his investment decisions based on emotion, and he can implement the next key takeaway from Benjamin Graham, which is understanding the importance of having a margin of safety. Even aggressive investors need to be aware of their margin of safety, since it acts like a lifeboat in the rough waters of the market. Ted begins looking for companies to invest in that have strong financial positions, stable earnings, and a good track record. Those characteristics are what provide a margin of safety. They are the intrinsic value of an investment, and Ted knows only to purchase a security when its market value is less than its intrinsic value. Each investor has their own margin of safety they're comfortable with. Warren Buffett called the margin of safety one of his cornerstones of investing, and has been known to have a target price of 50% of the intrinsic value of a stock. Ted's personal margin of safety is a discount of 20%. So when he determines that the intrinsic value of the tech company he's analyzing is $162 a share, he decides his target purchase price is a 20% discount of that, or $130 a share. Because the stock is currently priced at $192, he decides to pass on the investment. Ted picks a different tech stock that falls within his margin of safety. Still, he knows he needs more than just investments in the tech sector in his portfolio. That's because Ted understands the next key takeaway from The Intelligent Investor: understanding the importance of diversification. Benjamin Graham points out that investing in a variety of different assets can spread your risk and protect your portfolio from any one investment not performing well. Ted knows if he puts all his money into tech companies, he risks losing it all if the tech industry stumbles into trouble. But if Ted can invest in a mix of companies across several industries and asset classes like stocks, bonds, real estate, or cryptocurrency, he'll see higher long-term returns. Diversification may also expose you to new investments you would have otherwise overlooked, increasing the chance of snagging a high reward. Many investors diversify by buying an index fund or ETF, but you can also handpick each asset you want to invest in. Ted decides to invest in an index fund, so his investments can safely coast along with the broad market growth. But he also purchased some shares of standalone stocks to flex what he learned from the next key takeaway in the book, understanding the importance of fundamental analysis. Ted knows that buying within his margin of safety and diversifying his assets is vital, but the real secret sauce of selecting great investments is fundamental analysis. This is the process of examining a company's financial health, industry position, and competitive advantages to determine its intrinsic value. Once you have determined that, you'll know if an asset is overpriced or undervalued, allowing you to make smarter decisions. Benjamin Graham introduced a specific formula to find the intrinsic value of a stock. It looks like this. The formula was updated in the 1970s to include a risk-free rate of 4.4%, the average yield of high-grade corporate bonds in 1962, and the current yield on AAA corporate bonds, represented by Y. If this formula seems confusing to you, don't worry, you don't need to use it. As long as you stick to the core ideas, calculating exact numbers isn't required for most investors. Of course, if you want to follow Benjamin Graham's exact formulas for fundamental analysis, you certainly can. They still hold up marvelously today. Ted also wants to include cash flow statements in his fundamental analysis. He believes it's much harder to fake cash in the bank than to manipulate earnings statements. That's fine. It's Ted's decision after all. He also knows that his personal formula for fundamental analysis can change over time as he becomes more experienced. As long as a fundamental analysis can tell you if the security is overvalued or undervalued and helps you make better decisions, you're golden. Ted is still new to investing, so we've yet to see if he will settle for defensive investing or get more involved, becoming an enterprising investor. According to Benjamin Graham, defensive investors aim to protect their capital from losses, generate decent returns, and minimize frequent decision-making. Enterprising investors spend their time actively managing their portfolios. There's nothing wrong with either approach. Whichever investment strategy works best for you is right. Just be aware that being an enterprising investor will require significantly more time commitment than a defensive investor. In my opinion, most people are better suited to defensive investing. Even though The Intelligent Investor was written over 70 years ago, the principles Benjamin Graham introduced are still just as applicable today. Even seasoned investors continue to turn to this book for advice, and for good reason. It's a reminder to keep our emotions in check when it comes to investing. That's why understanding the psychology of money is the first thing we need to do before we even begin investing. Click my video summary of this amazing book that's on your screen. It just might change how you view money forever.